Did you scale, quote unquote, organically in terms of your own investments, or did you start bringing in some outside capital as far as syndications or fundraising goes?
Everything's a negotiation. You got to understand the other party's needs, wants, motivations. I've learned it's easier to take from people's upside and their future than it is to take from their present and their security.
What was the thinking behind starting to manage other people's properties? Were you trying to get cash flow for future financing of other real estate deals?
We were able to negotiate some creative financing structures.
How much can I afford to spend on getting a new owner? What's the retention rate of your portfolio? What's the lifetime value of an owner? You're a numbers person, so I'm curious to know how you are looking at those metrics. Are there any tips?
When you start doing third-party management, everything becomes more complex.
All right. Welcome everyone to the Hospitality Edge podcast, the podcast where we bring together what we think are two sides of the same coin, real estate and hospitality. Today, I'm super excited to have Fred Boothby with me. He's the founder at Enjoy Unique Stays, property management company, and he's been doing this for many years. So I'm super excited to dive into his story, the lessons that he has learned along the way. So thank you so much, Fred, for being here today.
Thank you for having me, Sebastian. It's always good to see you. I used to seeing you in person, but it's great to see you here as well.
Absolutely, Fred. So, Fred, I like to start this with the podcast. It's called the Hospitality Edge. So, what do you think? You have a very unique name. Enjoy Unique Stays. I love that name. What do you get? What do you guys do, or what do you think sets you apart in terms of the way that you deliver hospitality, which gives you an edge?
I would probably say two things. One, I think we're diversified and balanced. And so we do a combination of third party management, but we also own a significant portion of the inventory as well. And then, so between the management and the ownership, it gives us stability. We don't have to worry about losing a significant portion of our inventory. And it helps us balance, it helps us really as a team stay focused on the client too, because when you manage a significant portion of your inventory, all your processes are designed around taking care of that owner. And so I think that helps us to really understand owner needs and really focus on that. And then the other thing I would say that has helped us with the edge too is we focused on niches. And so identifying what we feel are niches of opportunity or profitability or areas that we can get economies of scale or develop a moat around our business has been things that have helped give us an edge as well. But really,
Interesting.
I think at the end of the day, just understanding the owner and focusing on results for that owner.
Because you are an owner yourself in your own
Yeah.
management program. So that is very interesting. Beautiful, Fred. So let's get into the story. So just give me some background as to how did you get into hospitality? How did you get into vacation rentals? Was it the real estate side first? You just started investing and then you started self-managing from there, or like what were you doing back then and how did you stumble across vacation rentals?
Yeah, it was by accident. I think we I was looking to I was had a finance degree, I got into banking for 8 years, did commercial lending, and I was looking to leave and do something more entrepreneurial. Every time I was there, I would sit across from these business owners, and the equity side of the equation is so much more fun and interesting than the debt side. And so it's something I knew I wanted to do and didn't know exactly what that looked like. And it wasn't vacation rentals that I decided to do. It was moving to Florida to run a lawn care landscape irrigation business, which was a change. And the way that we got into it by accident was with that move. My wife married me because she thought I was the safe choice. She thought I would never move away from family. So as part of the move, I told her, look, you can go back as often as you want, 2, 3 weeks at a time, every 2 months. I'll fly up in between. And so that's kind of how we accidentally got into it, because she would leave for weeks at a time. I'd go fly up in between. And whenever she was gone, I'd leave the house. We'd rent it out. I'd go sleep at the shop and had a mini fridge and a microwave and a bathroom and a hose over a tree out back for a shower. And so we started renting out the house that way. And then we really enjoyed, we were started out full Airbnb. So didn't know about property management software, didn't know about other channels like Verbo necessarily. and so and so we just we liked it so much and enjoyed meeting new people. We rented out a room of our house even when we were there, and met some really awesome, incredible people as well. So
Okay.
that's
Okay.
how we
So
got to it. And
it
then
started by you renting a room.
well, when we were there, we'd rent a room. When we were gone, we'd rent the house. So, and that was in a 3-bedroom house with 4 kids. So it was tight.
All right. And so how does that go from that to you actually taking this more seriously and saying, you know what, this is actually a business that I could scale.
Yeah. So I mean, seeing the numbers that it was doing, and then just being a numbers oriented guy, I started running some numbers, and so then I decided, well, I'm going to convert. Looking at the seasonality of it too, I think pretty much anybody that wants to be a one, if they're two incomes and they don't feel like they can afford going down to one, or if they're one income and they want to pursue something, and they're willing to move, the easiest thing to do is to pick two seasonal markets that are both seasonal but opposite seasonality. And so we weren't in two opposite seasonal markets, but Florida's year round, and then Michigan is highly seasonal. So what we started doing was spending the winters in Michigan, because the lawn care landscape business is slower in Florida in the wintertime, and nobody wants to visit Michigan in the wintertime. So we'd live there for 5 months of the year, and rent out the house in Florida for nice rate. And then when we were in Florida, the house in Michigan would rent for crazy numbers during the summer. So if
Mhm.
anybody really wants to get started and they have a home in a seasonal market that they can short term rent, the best thing you can do is pick a market with opposite seasonality, buy a house there,
Mhm.
and live in each house in the most unpopular times. So it may not be the most fun time to be there, but not only can you cover all the expenses of both homes and live for free, you can probably do that and make some good money at the time. Which, in terms of freedom, like, you may not choose when you want to be where you want to be, but you're buying back your time and freeing up your time to do other things. So that that's how we started doing it, and then from there it just grew to around 2009, 18, 19 was when I decided, like, hey, I think I can make a business out of this, and had a goal of doing some tree houses, and also had an office building. So then just started looking at different properties, and thinking, like, okay, is this a property I can make money on with short-term rentals? And it's not good from a branding perspective when you're just looking at things saying, hey, what's a good real estate investment? Because you end up with inventory that makes sense from an investment perspective, but when you start assembling all of these different types of inventory that you can make money from an investment perspective, they may be different types of inventory to manage. And so we ended up with inventory in a couple different states, and anything from cheap boutique hotel style units in an office building up to 9,000 square foot homes. And that's not real conducive to systematizing and branding and marketing. So I don't want to say it was a mistake, but in looking back, I wish I had the hindsight or the foresight to recognize that if I put a little bit more thought to the management side and the branding of the management business, it may have influenced some of our investment decisions with some of the projects that we went into.
So we're gonna go back to that point of like being very selective with the properties you bring on and keeping branding in mind. Before that, I just wanna understand the timing of this. So here you are changing houses and sort of house hacking in a way because you're living in the high season. You're leaving the place empty for the high season so that you can rent it out while you're living in the other place in low season and so forth. When so do you go from that, because at this point you still had, from what I'm understanding, the landscaping business, so you were
Yeah,
still
yeah. So,
running that on the side,
yeah,
and then
yeah.
your next
So
move is to buy the treehouse. Is that the next sort of move from there?
we wanted to start building them. We ran into some problems with getting water to the site that we bought. So I think I bought the property in 2018, and I was having challenges there. Was looking at doing a office building conversion to short-term rentals, at least the upper level, to put in 10 units there. And so I was looking at different things, and I think it was 2019. I went to a darn conference, I believe, in Gatlinburg, and met a lot of great people. Started realizing, okay, if I'm going to add units, I need property management software. I need to start understanding this property management game. And and look at starting to put systems in place that you can scale and add team members and build a culture around. So so started looking at those things. And so it's 2000, at the end of 2019, I think we had three moving to five properties. And I had one in Michigan, one in Florida, and then I had one other one in Chattanooga. And I think we picked up
But at that point,
two
all,
more.
all are your properties. You're not managing other people's properties yet. These are
Correct.
these are
Yeah,
your
we
personal
started
properties.
working. Yeah, we started working with other owners in early 2020, and then we started to put plans in place for we are in 2019 we were building out the office building units, renovating them. We did a gut of 6,000 square feet, and we're renovating that space. So throughout 2020, we bought a couple more, and then we also landed a couple large investor relationships that started to grow, and then on in terms of inventory that they were shifting our way, and of course COVID hit in 2020, and so all of that was some interesting things going on, and so we had a lot going on. But over that 4 year period, I sold the lawn care business at the end of 2021, and so it was roughly 4.5 years now we've been doing this. And the first 2 years of that was part time while I was running another business in Florida. And then the last 2.5 years or so has been full time. And during that time, we moved from Florida up to North Carolina. Chattanooga,
Mhm.
Tennessee is our biggest market. And we do have some properties in Southwest Michigan. And we're looking to expand into markets in the Smoky Mountain regions.
Okay, okay. So let's do two things. First, let's go fast forward to today to get a sense of like how far you've come. So, but then I'm gonna actually go back because I want to understand. I want to understand how you grew. So right now you have. Tell me a little bit more about your portfolio, like the size of your
Yeah,
portfolio,
so
the
we
size of your team. Yeah.
manage a little over 100 units now. Of those, we have ownership in close to 50 of them, and that most of the over half of the inventory is multi-unit sites. And so a lot of those in the early part were kind of found a niche when interest rates were low where we could find a property that maybe had 6 or 7 cabins. They weren't on Airbnb, weren't on VRBO. They needed to be remodeled. The standard of the property would not meet a guest from Airbnb or Verbo. So we were able to negotiate some creative financing structures. I mean, some of the properties just made no sense at all from an acquisition standpoint. The numbers just made no sense at all. But it was the belief that the revenue numbers could be turned around. So they were value
Hmm.
add. They were value add plays where we came in and worked with a seller with 100% financing, or sometimes we put negotiate to put some money down, but really tried to save most of the capital to go into improvements into the property. So we'd rehab them and then bring them up to Airbnb VRBO standards, list them on the channels, and we were able to create some pretty significant equity gains for those projects. And so that so that's how we got going with a few of them, particularly some of our Michigan properties: Sister Lake Cottages, Lake Huron, Rivers Edge Lofts, and then as interest rates started to go up, but also more so, we just realized we really want to focus on the type of inventory that can do well on Instagram. So we like the multi-site concept where we have 6 or 7 cottages with smaller units. We can get more economies of scale with cleaning and maintenance and
Hmm.
just operational efficiencies. And we have optionality where people can book a single one or they can book the whole place. So we liked that ability to host larger groups, but also fill in the gaps with smaller stays too. So we really like that niche, but we wanted to focus more on new construction and really go raise the price level that we were investing in these projects per unit, and also just trip them out with amenities and gathering spaces. And so that was kind of the plan all along with the tree houses we wanted to do. And so as we were able to get the issues with the water worked out, we're able to go back to developing that project. Right now, we're probably about 75, 80% of the way completed with the first project that we're doing outside of Chattanooga, Tennessee. And we have another project. We're in an earlier phase. It's a bigger project between Asheville, North Carolina and Greenville, South Carolina. So we're excited about that as well. So
Okay, so a lot of things to uncover there. So some creative financing along the way, some seller financing for the earlier stages of, say, growth. You were going with value add type of approaches where you were just believing in the potential of these properties, and you were not like saying, oh, worst case I'll rent this long term and the numbers will work. You were really like betting on,
Sure.
we're going to turn things around, and this is going to work. Just help me understand something. Did you scale, quote unquote, organically in terms of your own investments, as far as from that increase in equity, you would go and refinance perhaps when rates were low and buy something else? Or did you start bringing in some outside capital as far as syndications goes or fundraising goes at some point as well?
Yeah, so I mean, my background was in lending and commercial banking, and I've always enjoyed like creative deals. So I spent 4 years in the workout area of the bank. And so everything's a negotiation and you're trying to figure out the best outcome. And to do that, you got to understand the other party's needs, wants, motivations. And and what I would say is in general, I've learned it's easier to take from people's upside and their future than it is to take from their present and their security. So depending on who you're dealing with, you got to understand if they want the same things you do, getting the negotiation done's hard because you both. But if somebody has different desires than what you do, and you can and you're negotiating with somebody that wants security, and you're wanting and you can get upside or future, then you can negotiate things where you can protect them and you can still realize a lot of opportunities. So the first deal was the office building unit. I had a partner involved. He had concerns about the business model, and so I negotiated to buy him out. He financed the buyout. I went to another individual and I convinced them to do a private loan. So that wasn't equity. But to sweeten the deal, I did give them an option to convert some portion of that note to a 10% equity position. So I've done a lot of creative stuff like that. We found another deal on some cottages, and the seller wanted 400 grand. These cottages were doing $20,000 a year in revenue. So there was 7 cottages. They weren't doing 20,000 a piece. They weren't doing 20,000 a month. All 7 cottages were doing $20,000 in revenue for the entire year. And 400,000 is cheap, but 20 grand's like, is it even worth buying? So we got them down to 375, and I got some other partners to kick in the 50 grand and the money for the rehab. And so it reduced our risk because we didn't have any capital in the game. And we got a seller and some investors to work together to make the deal happen. And we were able to treat most of their money as a loan. And then when we did the refinance a year and a half later, we were able to get into a 50-60% equity position. And I think the cost on that deal were around 600,000, and I don't think the appraised value was real, but it appraised for 1.2 million when we were done with it. So we bought it for 375, put about 200 into it, and somehow got a crazy 1.2 million dollar appraised value. So it did make it easy to refinance 100% of the cost. So we were able to do that a couple times with a couple projects. And what we realized is we don't like managing older inventory. It's not as fun. And there's not as much money on the management side when you're managing the cheaper stays. And so our goal was to get into nicer inventory where we could still realize good cap rates and good cash flow and still do the smaller units multi-site. But with new construction, it's going to cost you more, but you're also going to be able to rent it more, and you're going to have lower expenses and higher reviews and more elasticity of demand. You can do more to be able to boost that revenue than what you can with something that's 60 years old that you remodeled.
Got it. So again, couple of things to try to uncover there. So first was the office building conversion to STR. Let me start there. Was that a concept that you had heard of, or for you it was just like, okay, I'm wanting to do STR. I found this deal, and zoning. What was zoning even a concern? You had to look into changing zoning there for that to take place. Like, let's say if we look at that first deal, because if I understood correctly, it was the first large renovation project, or at least converting it to STR. What did you learn in your first deal that you wish you had known when you first were getting into that you then took on and applied in the coming deals afterwards?
Yeah. So what I would say is like I probably would never have bought that building to do what we did. It would not be what I would consider doing. But it was a deal where it was a 13,000 square foot office building almost on 1.3 acres on the river, across from the hospital in town, 50 parking spots. It wasn't that old of a building. I mean, it was old, but not like downtown, small downtown old. It was built, I think, in the 1980s. So it had great bones. It was free space you could open up. We bought it in 2012. It had last sold for I think 950,000, and in 2012 when it got foreclosed on, we bought it for 239,000. So we just got it really cheap, and it was like always 50% occupied. Couldn't get it was in a smaller distressed tertiary market north of South Bend, Indiana, about 20 minutes north of Notre Dame, South Bend, Indiana, and so we had challenges with the office building. There is no elevator to the second story. So it's like, okay, what can we do with this space? How can we make this work? So it was just exploring a lot of ideas and then realizing that there's two hotel units and two hotels in Niles that have 200 units, but none of them are downtown. So I started doing some numbers and it's like, okay, if I could pull 5% of that traffic downtown instead of out in the strip between Niles and South Bend, then I think I could do quite well. So it was zoned, hotels were allowed in the zoning, so that wasn't an issue. So there was a few things to work through. The biggest mistake that I made looking back and the lesson that I learned from it going forward is don't try and save money. Like in the construction process, it's tempting to do the cheapest thing or things that are a little cheaper that you think you can get by with. But and that's one of the challenges of buying older inventory. When you're designing it new, you can say, okay, I have to design this for maximum occupancy. So whether it's the plumbing, whether it's the hot water heaters, whether it's the electricity, the HVAC, whether it's soundproofing, all of those things have to be designed for like the worst times. And so I soundproofed all of those units. I used all the soundproof insulation, thought I did everything right. But what I learned is there's methods of soundproofing that are above and beyond what I did. So I should have spray foamed the ceilings. There was that corrugated metal, and it was so they're modern industrial. They're open ceilings. They look cool, but we should have probably sprayed those ceilings to improve the insulation. And the walls, we built 2x4 walls with noise deadening insulation. We should have done 2x6 walls and staggered our studs to create air spaces to also reduce the noise. So we get good reviews overall, but our biggest complaint by far is the lack of sound privacy between the units. And at this point, unless somebody listening has some great ideas for me, which that would be awesome if somebody wants to follow up, and it's not cost effective to go back and redo all the interior walls that we put in. So I would say just little things like that when you're designing spaces, it might cost more upfront, but there's things that you need to consider for short-term rental that aren't readily apparent. And that's a small thing, but even individual units, amenities and things like that, you have to think through. Is the guest going to know how to use it? Is it going to hold up? Is it going to be functional? All of those things.
So I think right now you are vertically integrated, as in like you have your general contractors company. You also manage and have your own portfolio of investments. And was that the case back then? Like, because you seem to be very familiar with a lot of the terminology that goes into construction. Was that part of your background, or is that something you developed along the way? Did you always have like a more construction profile partner with you, or tell me a little, because you said earlier that your background was in finance. So
Right,
where
right.
does that
I mean,
construction division come into play?
before we moved to Florida, real estate's always been something that's interested me. So we through the tax sale and other foreclosures, we bought a number of single family homes, renovated them, and either converted them to rentals or flipped them. And so I had some experience in construction from that. Actually, learned a lot from my wife. Her dad's a builder, trim contractor, and so she knew more than I did when we got married, and we would work on homes together, and she would teach me stuff. So I learned a
Okay.
lot from my wife. But yeah, I mean, the early projects, we hadn't built out a team as much. We had a smaller portfolio. More of my time was spent overseeing the renovations. So from Florida, we were managing properties in Tennessee, had a partner there that was helping us there. And then I was overseeing a build project in Michigan. the office building build out, and then the cottage renovations. So that there's a lot of mistakes that I made there, a lot of things that could have been done differently. They cost me time and money. And over time, we've worked to build out a team. And I think I'm really proud of the team we have now. Tyler Willie runs the management of the management company, and he's done a wonderful job with that. And then my Ron, my cousin, is our licensed general contractor, and he oversees all of our construction projects. And he has a background in yacht construction, so it's not conventional building, but it's designing small curated spaces for short-term stays just on water. And obviously, people that are
Hmm.
buying yachts are expectations, so his attention to detail is very good. But yeah, we have the management company and the construction company, and we got great people on both teams.
Okay, so the decision for you to say the construction is going to be in house, I'm not just going to partner with a third party company, I'm going to have this be in house. Does that come when you are also deciding that you want to start doing new constructions, or was that a
Yeah,
decision
that
that
was
happened before that?
no. We had started the construction of the tree houses at that point, and we were working with somebody trying to decide where we wanted to take the construction company and how much we wanted to focus on that versus just developing. Do we want to develop and build, or do we just want to develop and hire a builder? So I wouldn't say that that's an easy decision. I mean, the benefits of not taking on the construction is there's a lot of mistakes that can be made, and contractors have relationships with subs and everything. So I think that's a positive to working with a contractor. The challenge when you're doing smaller footprint, unique stays that you want to be highly involved in the design process and very curated is I think at least I would drive most contractors crazy because they're like, no, 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 what's the plans? And this is what we're going to build. And this is how construction's done. And we're trying to build something that's unconventional, something that is going to shock the sensitivities and make people think like, wow, that's really different and in a good way. And so I think that's a challenge. Plus, generally speaking, I think unless you're in a really big market, which it's very competitive and it's very hard to get in an area and just develop a relationship with one builder and just keep doing it over and over again. So that's a challenge whether you want to do stuff in different areas. You either have to build construction teams in each area, which is a challenge, or you have to find different contractors to work with. So I don't know that there's a good solution for the challenges of construction, but I think it's worth figuring out. But ask me again in a year or two, and I might have a different opinion.
Yeah, yeah, yeah. No, that's interesting. I think it takes some guts. It takes some level of expertise, because if you're completely like non-familiar with construction, like perhaps you don't take that in house. Perhaps, I don't know, but you did, and that's working well for you now. Tell me more about the model of, well, two things, right? When you decide to start managing other people's properties, because you started with your own investments, what was the thinking behind starting to manage other people's properties? Were you trying to get cash flow for future financing of other real estate deals of yours? Was it just like, hey, we have the infrastructure of cleaners and maintenance and whatever that we're using for our own properties, might as well make some money out of it too and have some economies of scale? Like, and is that a focus of yours currently too, the management side of things, or are you more focused on
Yeah,
the new constructions? Just help me understand where the management piece falls into your grand plan or scheme of things.
yeah. So I mean, I go back and forth. I think the management side is great. It definitely helps you get more economies of scale, density in markets. It makes marketing for guests more affordable. So there's a lot of benefits to it. It's also a challenge in that as an owner operator, you're having to figure out all the best systems to manage your property. So you're thinking about, okay, what systems do I need for the guest? What systems do I need to develop to maintain the property? And when you start doing third party management, everything becomes more complex, more than I realized. So you start to deal with the fact that you have to consider whether or not you're going to go, what the business model you're going to go, if it's going to be more like Evolve where you're partnering with owners, or if you're going to go into full service and then you have to get into trust accounting and licensing, realtors licenses and stuff like that too. So I think there's some challenges that add more expense with third party management that shouldn't be underestimated. And then the other expense that I didn't anticipate is there's certainly the cost of acquisition. So it costs money to go out and acquire a third party client. And part of that cost of acquiring that client that has to be considered is retention rate. So with your own properties, you don't ever think, I'm not going to lose this property unless I choose to sell it. But with a third party owner, you've not only got to manage the guest and the property and develop some new systems to make sure that you can be in compliance with the law and take care of that owner. But now you need to manage that owner because now all of a sudden it's their property. They have opinions about how it should be managed. They have opinions about how they want to be communicated with. And now you have this owner relationship you've got to manage. And you've not only got the cost of acquiring that, but you've got to retain that client, and there's a cost to anything that you lose. So I think it's a good business model. I'm glad that we don't have 100% of our portfolio being third party managed clients. And I'm also glad that we have third party clients because I think that both for us anyways, I think both are valuable. But yeah, our goal in doing it was thinking, hey, we can do this better than anybody and clients will just flock to us. And the reality is, even if you're better than your competition, which I think when we went to Chattanooga, there was one other property manager there, and within 2 years, we owned the market. So, but I thought that they would just come running as soon as we opened our doors because the management fees were so high before, and the revenue performance was so poor. But there is a lot of stickiness to relationships in this industry because they're based on trust, and so people will stay in a relationship. It takes time to cultivate and win that relationship because it takes time to build that trust. And so so I think it's an interesting challenge, but it's certainly one that's worth figuring out. We'd like to do more of, and part of our challenge is like, hey, what can we do to improve our systems so that we are deserving of that trust? So what can we do to improve our technology? What can we do to improve our transparency with owners? What can we do to create the highest value proposition for owners that we can? And all of those things make us better and stronger. And so I think the more we can focus on that owner to understand what's important to them and to let them see what we're doing and how we're doing it. If they want to do it themselves, they'll do it themselves. It's not like there's anything that we're doing that's a secret. And the more that we can help them understand all the work that goes into managing their property and be transparent and even let them see like, hey, sometimes we mess up, sometimes we're not perfect, but we're not going to hide anything from you. And I think
Hmm.
that's very important.
No, those are very good points right there. It's like you're an owner operator. Yes, transitioning into management might sound like a great idea, and it might be a great idea, but don't overlook those details that you just spoke about there. And I think the customer acquisition one that you talked about is crucial, right? Because it's like, okay, how much can I afford? Like, how much can I afford to spend on this client? On getting a new owner, well, how long is an owner staying with you on average, to your point, right? Like, what's the retention rate of your portfolio, and then from there, what's the lifetime value of an owner, right? And then you might be able to say, okay, I'm gonna spend a certain proportion of that lifetime value in customer acquisition. All right. And then what are you including in that customer acquisition? Because I think that people sometimes forget that it's not just the marketing and it's not just the sales, but it's also the cost of onboarding, and it's also the cost of that strategy
Yeah.
call you need to have with the owner at first. And yeah, it's very important.
Yeah.
You're a numbers person, so I'm curious
It's
to know
very,
how you are looking at those metrics. Are there any tips you would give in terms of how you've adapted the way in which you look at whether that's customer acquisition or whether that's lifetime value or whether that's your churn rate? Are there any tips in terms of how you've evolved the way you measure those numbers?
yeah, I would say I I love numbers. I love trying to figure that out. So when I started thinking about it, it's like, okay, I've got to figure out if we're going to spend more money going after third party owners, I have to understand like what's the return on any money we spent to do that. And so, like you said, a lot of people don't count all the costs, but I looked at it and said, okay, who out here can help me figure out how to measure this? And so I started Googling and looking for resources. I couldn't find much. I think the best the best tool that I found, if you Google it, I'm sure you can find it. But Brooke from Ventori has like an 11-minute video that I think does a really good breakdown on calculating cost of acquisition and lifetime value. And so I actually watched that video about 5 or 6, maybe 8 or 10 times with a pen and paper. And I'm taking notes, and then I watch it, rewatch it, stop it, pause it, because you're like nobody really gives it to you, and it's all really like everybody can run numbers different ways, but I think you have to say, okay, what's the marketing cost? What's the time of anybody that I have who's dealing with the leads coming in, who's meeting with the prospective new owner, who is getting them to sign the contract, who's going through all of the setup process with them. What's the cost of the locks, hardware, stay-fi, locks, cameras, photography, anything that you commit to paying to bring that client on board, stocking the supplies for the first time. And I mean, you try and pass on costs to your owner as much as you can, but it's a competitive market, and you got to decide how you want to make it easier on the front end and make it up over the value of the lifetime, or if you want to charge the owner up front for those things. But you figure out all those costs and you track those. And what we do is we track those monthly, and we track the number of properties we onboard monthly, and then we track a trailing 12. So on our trailing 12, we know what we've spent in customer acquisition over the last 12 months and all of those areas I just mentioned. We know the number of properties we brought on over the last 12 months, and that gives us our cost of acquisition per property. It'd be better if we could break that down into a cost of acquisition per revenue, but right now it's just cost per unit, because some units would be a 9,000 square foot house that does 200,000 plus a year in revenue has more value than some units that might do 20 or 30,000 or something in between. But but anyways, we that gives us a cost per unit, customer acquisition cost or PAC, property acquisition costs. We then take that and divide that by the retention rate. So we also track our rolling 12 retention rate. So if we take that cost of acquisition before retention rate divided by our retention rate, now we know when retention rate, which is also part of the cost of acquisition, when that's factored in, we now know what our cost of acquisition is, including retention rate, the cost. And then we take that number and we divide it by the average profitability of our properties in our portfolio over a rolling 12. And that tells us what's our payback period for any money we spend on marketing. And so, depending on who you talk to, people like Brooke from Ventori make those numbers sound highly compelling because they're like, hey, look at the value of owner acquisition strategies and we help you with that. And I think they do a good job. And I think that I think that even though their numbers to me are not like they don't when they give their examples, they only use the marketing costs. They're not factoring all those other costs. But I think one way to look at it is what does it cost to acquire new business? If you're going to go out and buy a property management company, what are you going to have to pay? What are the numbers you've heard in the market? Three to five times
I
earnings,
mean,
three to
it's
five EBITDA.
sometimes a multiple, yeah, multiple on EBIT. Yeah, yeah, yeah. 3 to 5 EBITDA is usual.
So the smaller the portfolio, it's based on more like an asset purchase, how much you're going to pay per listing to acquire a business. But people that are buying 50 to 100 plus units are going to look at the value based on a multiple of EBITDA, adjust for unusual things or whatnot. And so I look at it and say, okay, if the business is worth 4 times EBITDA that I'm building, if it takes me 4 years to get my money back, I'm not adding any value when I grow. So if my payback period on my marketing dollars is 4 years, I'm adding business that is worth exactly what it cost me to acquire. There's no value creation. So I have to get my payback period as low as possible, but certainly, in my opinion, well below 3. If I can get it down or under 2, then that means if I spend $500,000 on marketing and sales, and my payback period is 2 years, I'm gonna be making 250 a year. If it's worth four times that number, that $500,000 investment's worth $1 million. So if I invest a 500,000, I'm creating 1 million of value. That's a really good return. So for us, our payback period when we started tracking it and started marketing was over 3 year payback was right around 3. We've gotten that to come down and it's still above 2, but we think we can get that down towards 1.5. And there's other variables that come into play. Like if you're entering a new market, you can expect that your organic cost of acquisition is going to be much higher because you don't have any brand value, you don't have any operations there. So if you're going to go into a new market, you've got to realize the cost of entering that market is going to be higher, which also explains why property managers, when they enter a new market, sometimes they'll go look for a smaller property manager to buy so they can get their first 10, 20, 30 properties in that market because they know that getting started is expensive and hard. And so I think understanding these things is like a fun challenge, and it's one that you guys know well because you're growing all the time too. So
No, this is
you
this
there?
is great. Yep. Yeah, yeah, yeah. Can you hear me now?
Yeah, yeah, yeah.
Hello. So you talked about how your payback period has decreased. Of course, part of that, to your point, is decreasing the cost of acquiring a new owner, which might happen naturally as you get more brand recognition and more traction in a certain market. But I think there's also the other side of it, which is how do you make more money, more lifetime value out of this particular owner. So I'm curious to hear strategies that you've implemented when it comes to that. Of course, there's the commission that you're charging for your services. Of course, the better job you do at educating the owner on the importance of pricing flexibility, the better results you're going to be able to obtain when it comes to the revenue you're making with that property. But what else have you done to increase that revenue that you can make per owner that has led you to decrease that payback period?
I I think part of it is just learning to if you can manage the more you can shift in managing higher quality assets, the potential to become more profitable is more likely. So in other words, like you can be the Walmart model. Vacasa's tried that. I've in they just laid off 5% of their staff again. In conversations with some of the team members that have been laid off, one of them told me that her boss referred to them as the Walmart model. And I think the challenge with being the Walmart model is you're making a very little amount of money on each client, and to do that with scale and quality, very hard to do. And so our strategy overall has been, hey, we know in general that the higher the revenue property goes, the lower management fees they expect, or another property manager. Our competition is willing to charge a lower management fee, and they should be, and we are too. So if we have a property that's only doing $4,000 a month in revenue, 50,000 a year, we need a higher management fee than if we're managing one that does $15,000 a month or close to 200,000 a year. So theoretically, if we'd want 25% of 50,000, that's 12.5 a year. Well, if we got even only 15% of 200,000, that's 30 grand a year. So there's a lot more money to be made. Now there is more cost in managing higher revenue property. There's more work that goes into it. There's more. So I think we're trying to understand our costs better. And so that way we started with a flat management fee, 25%. And then over time that changed where now we charge between 17 and a half and 30. And I think the industry, as technology gets better, as AI comes into play, I think that's going to make more efficiencies for property managers, which is overall is going to be good for the value of the asset that we're managing, because as it becomes more efficient to manage properties, a competition will dictate that management fees continue to come down. That's my prediction. And maybe I'm right, maybe I'm wrong, but not because service levels need to drop. But what I expect is we're going to find it easy to justify managing some inventory for as little as 10 to 15%. And if we can manage it for less, but still make more overall because we understand what it costs to manage different types of inventory. So we've already gone from like a very just one management fee to a distributed management fee. And what we're trying to do is understand better, like, okay, for the little bit of inventory we manage at 30%, what's the cost of really managing that? And for the inventory we manage at 17 and a half, how profitable really is that? We know it's profitable. How much lower can we bring our management fees down? And if we can do that, is that helpful in picking up more inventory? Or do we need to focus on making sure our services, and it's a combination of both, in order to manage the best inventory, those owners and that inventory require really good systems in place. And that comes down to software, but it comes down to practices and people and culture. And I think when you look at people like Moving Mountains, Robin Cragen, I mean, that type of operation is so impressive that somebody can manage over 200 properties that are doing ADRs of five to $10,000 a night, and such deliver such high expectations. And learning from somebody like him, he'll tell you the most important thing is culture. And we certainly have a long way to go, but I think we're building a great team, and I'm very excited for the future. But if you think about where the opportunity lies, if you can shift into higher performing revenue, or focus on inventory that that like when we work with investors on these community projects, we're not likely to lose that client to somebody else, because how many other property managers are there that could service that well and actually compete with us in that? So so I think it's looking for niches. And but I do believe software and AI will bring the cost of property management down. And in terms of increasing the lifetime value of a client, if you can bring your operating costs down, then whatever the market rate is, you can carve out a nice profit margin there. At least that's our belief, and that's what we work on doing.
Yeah, no, that's very interesting. So the fact of having a flexible commission structure so that you're not overcharging the very high revenue producing properties, but you're also not losing money on the properties that make less is key. The fact of understanding how much it costs for you to deliver your service, not only in technology, but also in talent, understanding those unit economics is crucial as well, and the perspective on how the technologies that are advancing so fast with AI and whatnot is going to end up pushing management fees downwards. That's very interesting as well. Now, culture. I mean, we talk a lot about culture here. I want to talk about something else when it comes to the model, the model that you are currently working on of new constructions. I just want to dig a little bit deeper there. So, what is it? Is it you are buying the land and you're just building and you're managing, or are you selling some of the units to individual owners? And is there that as well as an exit strategy in the model where you're selling the units once built to individual investors, owners, and that's your exit, and then you're managing for them, or is it really just like build to rent?
Yeah, so I kind of, I mean, in Chattanooga, the property we built on, they had to be all built on one parcel. So it's built like a resort. I couldn't break them off and sell them individually. And so it's very much like build to rent. And the numbers weren't that good there. I think there is I think it is much smarter and makes a lot more sense to build on individual lots, develop it like a subdivision. If the rental revenue wasn't there, or depending on the exit strategy, I think there's probably likely that the project would sell for more on a cap rate, on an income based approach, if it's managed well, than it would on, because that's one of the challenges with residential property. The guys that manage residential property, you buy a house, you furnish it, you got a lot of costs into it, you go get it appraised, it's always going to be based off the sales comp. Like, even if it's like, oh no, this is an income producing property, it's like you're not going to get a premium valuation on a single family home, because anybody could come and buy the house next to it and do the same thing. But when you have a community project, even if they're individual lots, if you can create some magic with gathering spaces and the marketing and the management, That can be sold. That's proven, at least with Live Oak Lake, Steonera, and some other projects. It's proven that those types of models can be sold on a cap rate, which theoretically allows, with good design and good construction and good management and good experience packages and with good social media, if you can do, if the stars align and you can do all those things well, I think it's proven that you can create some real magic where the value can be more than costs, and create a nice exit. But to date, we have not tried to sell any of the stuff we've built as individual homes. If we did do that, I don't know anything about it, but I saw something about the idea that people are selling fractional ownership. So some of these condos and these ski resorts in Montana and Idaho and wherever, where to buy a condo might be $4 or $5 million, apparently. It blows my mind. Somebody will come along and say, hey, you could purchase a 1/8 ownership in this condo for $1 million. Well, now instead of getting 4 million valuation, now you've just sold 1/8 of it for $1 million a piece, and at least this article I was reading saying that opportunity exists and that is working. I don't know much about it. I don't know that we could do that, but that would be the most interesting way to me to realize an opportunity to sell units and get a valuation that would make sense more than just being a home builder selling spec homes.
Yeah, no, and you made a good point in terms of the the importance and the impact that it's selling based on cap rate can have. And I you mentioned if stars align, if stars align and you're able to sell based on cap rates, because I've had people here in the show that are big believers in this model. They're buying single family and aggregating it, and their hope is that they're going to be able to exit at a portfolio level based on cap rates, and that there's going to be institutional appetite for that. And then there's people that have been on the show that have mentioned that it's still too early, or it's we're not there yet, and it might come in the future. But you said that it's proven, and you alluded to a few projects that have proven that to be possible. What do you think needs to be in place for that to be possible? You said social media, you said having some sort of concentration of the different units from a geographical standpoint. What else
Yeah,
do you think needs to be
there's
true for that to be likely?
I mean, there's different models out there. There's certainly I mean, I've seen like some where they're like, oh, purpose built vacation rentals can mean so many different things. So, like I saw something where there's some purpose built vacation rentals being built in Port Aransas, Texas. Well, they're just single family homes designed with a lot of amenities, and it's a PUD or whatever, so they allow, and you just know that if you rent that house, there's going to be neighbors on either side that are also STRs, and it's not a neighborhood. Now, there might be some gathering spaces or something, but to me, the idea of purpose built can mean a lot of different things. So it can mean a neighborhood of single family homes. It can mean a hotel that's basically a hotel, but it's built with a little bit more of the vacation rental traffic in mind rather than the hotel traffic. But in the area of purpose built that we've decided to focus on is more these outdoor hotels or landscape resorts. Within that, I would say the two main categories are hard shell or soft shell. So there's a lot of people that are doing these yurts or tents or glamping sites. All of that I would refer to as soft shell. And that looks very profitable on the surface because the cost per unit is relatively low, and the rental values have been pretty strong. And so you look at that and you're like, wow, that's awesome return. But I think understanding soft shell, the life cycle of soft shell it's not something in 10 years that's an appreciating asset. It's that soft shell has a much shorter life cycle. It's more like a vehicle. It's going to depreciate. So the land and the infrastructure won't. And generally speaking, yeah, you can go replace all these dome tents at a not that much of a premium. But I don't think people really understand the cost of operating those, and the depreciation is one of those costs. And I also worry, at least myself, I wonder if some of those things might end up being more of a fad. than not. Maybe they won't be. I don't know. But we've chosen to focus on more of the outdoor hotels or the landscape resorts, particularly the hard shell model. And I think anything that's niche has a better opportunity. And so whether that's mirrored glass homes or tree houses or stone homes or there's a lot of fun creative stuff. But I think when you pick a concept like that, you've got to get you got to understand the client you're going to attract, and you got to know that market. And like we didn't know that market very well, and we're still learning it, and not understanding that on the front end has probably cost us a lot of money, because we've made a lot of not mistakes, but there's definitely decisions we'd make differently if we do it over again, because now we better understand our target guest. But understanding your target guest, designing the project specifically for them, having a good construction process in place, having what most people refer to as experiential stays or experience packages, where they're not just coming for a place to stay, they're coming for an experience, good management, hospitality, and then you've got to also, if all of those things are there, then the right social media over top of that will work. If you don't have the design right, if you don't have good experience packages, and you don't, some of those things you're missing, it really makes social media very hard. And so we probably will get more successful with all of them the more we do, but we certainly learned a lot in each of those areas along the way.
That's very interesting, Fred. I feel like the time has passed so fast that I could go on here for 2 more hours. Believe me, I'm enjoying this chat a lot. How are you doing with time? Do you have 2 more minutes?
Yeah, I've got whatever time you want. It's been great talking with you.
Yeah, no, it's been fun. So you talked about social media there. You talked about how you try to focus on building inventory that is appropriate for Instagram specifically. You said what has been the results of that in terms of how much you've been able to drive direct bookings as a percentage of your overall bookings for those kind of inventory?
Yeah. So to be clear, we're just getting going with the social media. So the social media is expensive. I think most property managers will tell you social media doesn't have a good return. And most marketing in general, and that's a big difference between property managers and owner operators. Property managers find guest acquisition strategies to be challenging because they've either got to sell their owner on the idea that they benefit from it too and get them to chip in and pay. Like, in other words, hey, this marketing is going to raise your occupancy and your average daily rate, raise your revenue. You should help pay. It's very hard to convince third party owners. They're like, well, that's your job. That's why I'm paying you to manage the property. That's what your management fee should cover. But owner operators, they don't look at it and say, how much management fees am I getting? They just look at it and say, how much is this going to improve my revenue? Am I going to get higher ADR, more occupancy, higher revenue? And if it's not coming through Airbnb Verbo and I can get direct bookings, how much more can I get? So I think for the landscape resorts that are small and owned by owner operators, the way they evaluate those decisions is much different than a property manager who's saying, I'm only getting 20 to 25 cents in the dollar from whatever value I create. So the more unique the inventory, I think the better it can do on social media. The less unique it is, then the less likely social media is to be effective. And other strategies like SEO and organic traffic or pay per click probably make more sense. The cheapest way, obviously, is just as you get more properties, trying to put good systems in place to collect email addresses and learning to be effective in retargeting those owners and learning to develop processes and systems. So before we started social media 4 years ago, Airbnb was 100% of our bookings. They dropped to 90, they dropped to 80. In 2022, they were almost 60%. Verbo was like 28, and our direct bookings were 13%. In 2023, we increased our direct bookings about 50%. We went from 13% to 19, and Airbnb dropped under 50, and Verbo got up to 32, 33. So this year with the conversion, we expect to be on booking.com and Expedia. We're going through a software conversion. And so we'll get a little more diversity, and we, with the social media starting, we'll see how much better we do with direct bookings. That's focused largely on certain types of inventory, and so we'll notice that more with those inventories. And we're doing it both to increase direct bookings and drive the revenue up on those properties, but we're also doing it as a way of getting more branding and exposure, because we think we've already seen that it's also helpful with owner acquisition too. So I don't know is the answer.
Yeah, no, it's interesting. You made a great point. No, but you made a great point, which is like, if you don't have inventory that's unique, like don't even bother. Like don't even bother with this social media efforts, because they
Yeah.
likely won't
So social media.
result.
Yeah, it's got to be something that can go
Sorry.
viral or have
Yeah.
potential to, or I said you got to have inventory that can go viral, and and I thought it was just like my idea of what would go viral. I realized I'm 40-year old. Most people think I'm in my 50s. So what do I know what young people want these days? So there's a learning curve in trying to understand what works.
Yeah, no, that makes sense. Fred, and if you look ahead, just to wrap up here, what is the future of your company? What does the future look like in terms of what's the vision for Enjoy Unique Stays? What are you most excited about when it comes to the company, when it comes to the industry? What's the vision for what's ahead for the company and the industry as a whole?
Yeah. So our mission is to help guests escape the ordinary, to spend time with people they care about and visit places they enjoy the most. And myself, I find nature to be very relaxing, soothing. I love connecting with nature. So we're definitely focused on places that we don't tend to focus on anything urban. We tend to focus more on traditional vacation rental destinations. Most of what we've done is more mountain regions. We certainly want to continue to focus on building out more landscape resort communities. We think that that's something that will be important for us to to continue to do and get better at, and we're very excited about that. And when it comes to third party management, we also know that if we want to keep the bar high and focus on delivering high value, it costs a lot to deliver results, and so we can do that better for third party owners if we focus on higher revenue properties. So whether that's larger homes or other unique properties. And so branding wise, we're focused on what we would refer to as our collection of inspired retreats that we're developing and our collection of inspired homes. And so most of the inventory that we'll own or raise capital on with other investors would be our inspired retreat type communities. And we'd love to work with any owners that would like to see what we can help them do in pushing the revenue on our inspired homes collection of really awesome homes.
Absolutely. Absolutely, Fred. Well, listen, I think this is going to be one of those episodes where people might have to take some notes. You shared a lot of good nuggets and pieces of advice. So, really enjoy the conversation. Really appreciate your time. And I look forward to seeing you at another one of the upcoming events. But yeah, no, this was a great chat.
Yeah,
Thanks
me
so much
too.
for taking the time. And
Absolutely. And
yeah, man.
yeah, look forward to connecting with anybody that wants to on LinkedIn. So
Yeah, absolutely. We'll make sure to share those links so people can connect. Have a good one, Fred.
take care.